Hello, we're going to have a look at some introductory accounting ratios, looking at Blue Limited. These ratios would be suitable for O levels or ordinary level leaving cert. Looking at Blue Limited's abridged trading and profit and loss account, we see they've got sales of 600,000, all on credit. They cost 410,000. Giving us a gross profit of 190,000, less the expenses including interest of 125, so we've got a net profit of 65,000, to which we've added the opening profit left over from previous years of 75,000, giving us a closing profit figure for the balance sheet of 140,000. So that's our final accounts. And then looking at the shortened balance sheet, we can see we've got our fixed assets of 450,000. And then we've got 170,000 worth of current assets, less the current liabilities, giving us, not written down there, working capital of 100,000. And adding the working capital to the fixed assets, we get 550,000 being the total of our asset side of our balance sheet, our net assets, 550,000. That's financed by an equal amount of capital employed. The capital employed here, 550,000. is made up of shareholders' funds of 440,000, which is the original share capital issued, 300,000, plus that P&L balance we saw earlier. So the company owes its own shareholders 300,000 by way of capital that they invested, plus the 140,000 worth of profit that the company has retained. So the shareholders' funds is 440,000. This company owes its shareholders 440,000, and it has borrowed 110,000 by means of long-term finance, in this case debentures. 9% debentures, that's of interest to us later. They owe their debenture holders, the banks, 110,000, and the interest charge on that annually is 9%. So we've got 550,000 euro worth of net assets, and we've got an equal amount of capital employed as you'd expect. And we look at 9 ratios to explain to us, ratios and percentages to explain to us how well or how badly the company has done. Typically we have 4 profitability ratios. Markup, which is gross profit as a percentage of cost of sales. You know, if something costs you €10 and you mark its price up by another 5 to get €15 as the selling price, you're marking up its original cost to get the selling price. That's the origin of the expression markup. But it's gross profit as a percentage of cost of sales, and if we go back to our original information here, we see that our gross profit is €190,000. And our sales are our cost of sales is 410,000. So the gross profit as a percentage of cost of sales is 190,000 over 410,000 by 100, giving us 43.64%. And as is important, we'll always go to 2 decimal places in ratios and percentages. That means you go to the third significant figure after the decimal point, and if that's 5 or more, you round up the second figure. So we have 43.64% markup. Then margin, or also called gross profit percentage, is the same gross profit, but this time it's expressed as a percentage of sales. So gross profit as a percentage of sales has to be gross profit over sales by 100. So we've got 190,000 over 600,000, which was our sales, and we have a 31.67% gross profit percentage. Markup and margin deal with the same idea. They're both dealing with gross profit, just looking at it from a slightly different perspective. The person working in purchases, who's used to dealing with the cost price, he would describe a transaction's markup. How profitable was that transaction? He's thinking in terms of cost, or she's thinking in terms of cost. So it's gross profit as a percentage of cost. On the other hand, the person with the sales perspective, the person selling might be thinking, my selling price is such and such, how much of that is profit. That's looking at it from a gross profit percentage point of view. They both describe how good or bad the company is or the firm is at buying and selling, because it deals with sales and cost of sales. A better measure of profitability, of course, would be net profit percentage. Gross profit percentage is fine, but how much of that gross profit still remains after dealing with our expenses of running the business? So our net profit percentage, and it's always net profit with the interest added back, the net profit before interest and tax. So net profit plus interest over sales. The net profit is 65,000 if we go back looking at our original abridged profit and loss account or shortened profit and loss account. Our net profit is 65,000. But that's after all expenses, and we want the net profit before interest, so we must add the interest back to it. Now there's no mention of how much interest is in the expenses, but we do know that the company has €110,000 worth of debentures, the annual charge on which is 9% for interest, so that's 9,900. So if the net profit is 65,000, the net profit before interest must be 74,900. So net profit plus interest over the 600,000 is 12.48%. By far and away the most important profitability ratio is the return on capital employed. It's arguably the best measure of how profitable a firm is, because it expresses the net profit as a percentage of the amount of capital employed invested to earn that profit. We can have an idea here as to why the interest is added back, because the denominator, the thing below the line, the capital employed here includes the debentures of 90,000. It includes the debentures of 110,000. So if the thing below the line includes debentures, the thing above the line has to include the return, or what is earned by those debentures. So again, the return on capital employed is net profit plus interest over capital employed. Our net profit is 65,000, the interest is 9,900, so that's 74,900, expressed as a percentage of the long-term capital invested to earn that, which is 550,000 capital employed, giving us a 13.62% return on capital employed. And you'd compare that with last year's figure to see if you've improved. And you'd always also compare it with the return on so-called risk-free investment. If you were to take no risk and put that money in a deposit account or buy government bonds or something, how much would you earn? So that will tell you if it's worthwhile taking the risk to run your own business. Compare it with last year's figure to see what trend, is it improving or a worsening trend, and compare it with the return on risk-free investment to see if the firm is profitable. So we've got 4 profitability ratios: markup, margin or gross profit percentage, net profit percentage, and return on capital employed. The next 2 ratios deal with liquidity. Liquidity measures the ability of the company to pay its debts as they fall due. The first ratio, the current ratio, also called the working capital ratio, is the ratio of current assets to current liabilities. And we saw on our balance sheet that this firm had €170,000 worth of current assets and 70,000 worth of current liabilities falling due soon. You wouldn't want to be using your fixed assets to pay your debts, however you would use your current assets. That's why we put the current assets in a ratio to the current liabilities. So we've got 170:70 or 2.43:1. So that for every €1 the firm has in debts falling due, it has €2.43 of current assets with which to pay them. A better measure of liquidity is the acid test, or the liquid asset ratio, or the quick asset ratio. And it compares not current assets with current liabilities, but it compares the liquid assets with current liabilities, the cash and near cash. The current assets with the stock taken out of it, because stock isn't something that turns into cash quickly. Strictly speaking, it should be current assets minus stock and prepayments, but in lots of exams they don't have any prepayments. So it's simply current assets less stock is the current liabilities. We had 70,000 euro worth of closing stock, so we know that the current assets less stock is 100,000 and our current liabilities are 70,000. So it gives us an asset test of 1.43:1. That means that for every euro the firm has in debts falling due, it has €1.43 in liquid assets with which to pay them. So this firm has no problem paying its debts as they fall due. And in fact, its ratio is above the recommended or ideal ratio of 1:1. Moving on then to stock management. Are we making efficient use of our stock? It's important that you shift your stock quickly. You don't want your stock hanging around the place where it can go off, it can deteriorate, it could be stolen. If you carry too much stock, you've got to insure it, you've got to warehouse it. So the modern idea of treating stock is that you want to keep it to the minimum necessary. Not too much, just enough for your sales or your production. And the best measure of how quickly you shift your stock is the one called stock turnover, which the formula for which is the cost of sales over the average stock. It's a simple average. It's just taking opening and closing stock, adding them together and getting the average, dividing by 2. So our cost of sales in the trading account was 410,000 euro. We see it up here in our abridged trading profit and loss. Our cost of sales was 410,000 euro. If you like, that's the total stock that one has during the year. And then we're dividing it by the average stock, which is the average of 60,000 and 70,000. So it's 410,000 over 65,000, which is 6.31 times per annum. It means that this firm sells its average stock about 6.31 times each year. The higher the figure, the better. If we had a figure last year of 5, it means we're turning our stock over more quickly, and that's good. However, if last year's figure was 8, it means that our stock isn't moving as quickly, and that's a bad trend. Perishable goods, of course, would want to have a much higher stock turnover than that, and that turnover there is more appropriate to very durable goods. It varies from industry to industry. And lastly, we're going to look at credit management. On the one hand, how quickly do we get our customers to pay us, or so-called debtors turnover, and then in turn, how quickly do we pay our own suppliers, that's our creditors turnover. So the period of credit allowed to debtors is our debtors divided by credit sales by 365, and that tells us how many days credit we're allowing our customers, or credit customers, or debtors to take. And in the case of this firm, 60,000 over 600,000 by 365 is 36.5 days. This firm is allowing its debtors to pay on average about every 36.5 days. Now, they're probably allowing them 30 days credit, but the customers are in fact taking 36.5 days. It's not too bad. How quickly, though, are they paying their own suppliers? What's their creditors' turnover? And here we have creditors over credit purchases by 365. And in the case of this firm, we get 61 days. So this firm is getting its money in every 36.5 days, but taking 61 days to pay it out. So you could say they have that the correct way around. It's better to be getting the money in more quickly than you're paying it out yourself. Being careful, of course, that you don't take too long to pay your suppliers, and 61 days is a long time, alright, it's over 2 months. You want to be sure to benefit from any discounts they're giving you for paying on time, and you don't want them to be cutting off supply because you're taking too long to pay them. Our multiplier here in both cases is 365 because you're getting the period of credit allowed and received in days. If you want it in months, you simply multiply by 12. So there you have it. You have 9 basic accounting ratios that can be used in the Leaving Cert or O levels, or as any introductory, or in any introductory financial accounting ratios course. Talk again.